Stocks just got hit big time. I mean, no wonder that Trump indictment came out as a distraction. Did you guys hear about this? The US just got a major credit downgrade from Fitch. Only the second over the history of the country. Last time this happened, we were coming out of the Great Recession and Congress caused a major deadlock with that whole debt ceiling deal. And looks like it's happening all over again, guys. JP Morgan Chase CEO Jamie Dimon, he said the whole thing is just ridiculous.
Well, let's talk more about America because Fitch, big news today obviously is the downgrade of U.S. debt down to AA+. Yeah. What's your take on that decision?
Yeah, I'll give you a couple of quick things. It doesn't really matter that much. The markets decide. It's not the rating agencies who make these big decisions. Number two, they point out some issues which we all knew about our debt ceiling crisis and things like that. But number three, most important, the American public, this is the most prosperous nation on the planet. It's still the most prosperous nation on the planet. It's the most secure nation on the planet. And I would point out to the rating agency, if I could, that there are a bunch of countries rated higher than us, like AAA, but they live under the American enterprise military system. To have them be AAA and not America is kind of ridiculous.
Now, I don't know about you guys, but when people like Jamie Dimon tell me not to worry, I tend to be skeptical about the whole thing. Oh yeah, let's take a look at this. Is there really nothing to be worried about? So just like you heard, Fitch, that credit agency that we all know, they have just taken a massive swipe at the US government's credit rating. Yup, they just downgraded it from the almighty AAA to the still respectable but not so glamorous AA+. It's kind of like your credit score taking a nosedive, and we all know what that means. Get ready to pay higher interest rates on loans, and I'm not talking chump change here. We're diving deep into the world of trillions of dollars here. Now, picture this. The US government, they're sitting on a colossal $32 trillion of debt. Probably a little bit more than you owe on your Visa card. And this is not even counting the unfunded liabilities that they don't even talk about. And let's talk about the fallout here, guys. With the credit rating tumble, the government will still be shelling out even more of its hard-earned cash, or rather, our hard-earned taxpayer cash on interest payments. And guess where that money won't be going? Yep. Things like military spending, Social Security, Medicare, welfare programs, SNAP, EBT, the works. So most likely a massive budget shuffling. Either that or taxes are going up. Think of it this way. When your credit score drops, you end up paying higher interest rates on loans, right? Now apply that same principle on a massive scale, the US federal government scale, with a whopping $32 trillion in debt, and that's not even considering the unfunded liabilities. You could see why this downgrade is making investors break a little bit of a sweat here. And like I said earlier, this is probably going to be eaten into the budgets for things like defense, Social Security, Medicare, a whole bunch of other government programs as well. Now, of course, the Biden administration, they hit back quicker than you could say credit crunch. They're not taking this stuff sitting down. They fired back, calling out Fitch's methodology and saying our economy is as resilient as ever. Get that, right? So Treasury Secretary Janet Yellen, she said also very strongly that she disagrees with Fitch's rating decision. And they're not forgetting to pin the blame on politics as well. Republicans, Trump, chaos. They're all tossing it into the ring. But here's a real kicker, guys. This is not the first time that the US government's been knocked down a peg. Y'all remember 2011 and the whole debt ceiling drama back then, right? S&P gave our country a downgrade too. And so now US credit worthiness is at the same level with Finland's, but still falling short of Switzerland and Germany. And it's not just about the numbers, guys. Fitch is pointing fingers at the steady decline in governance over the past 2 decades. All those political tuffles and turmoil that you guys have been hearing about. So the agency lowered the US government's credit rating from the top AAA grade to AA+, citing an erosion of governance. And it said that it had manifested repeated debt limit standoffs and last minute resolutions. And so now we get to thank Congress for pretty much dicking around and waiting till the last minute to actually make a decision when they could have done it months prior. It also argued that the country's financial situation was likely to deteriorate over the next 3 years thanks to tax cuts, increased government spending, economic shocks, and political division. But what do you guys think? Something to keep an eye on, right? Make sure you guys are updated with the latest financial happenings in the US and abroad. Make sure to hit that subscribe button now and also tap that notification bell right after. And hey, I totally wouldn't say no to you guys hitting that like button either, all right? Appreciate you guys so much for that. Now, if you ask JP Morgan's Jamie Dimon though, Fitch downgrading the US credit rating for the second time in America's history is ridiculous. But in the end, it really didn't matter. For him, it's ultimately markets, not ratings agencies that set borrowing costs. But still, he did criticize Fitch's decision, labeling it ridiculous, considering several nations that rely on America and its military for stability have better credit ratings than the United States. Countries that still have the highest credit rating at major agencies, S&P Global, Fitch, and Moody's Investor Service include Germany, Denmark, Netherlands, Sweden, Norway, Switzerland, Luxembourg, Singapore, and Australia. But he did point out how the United States should just completely get rid of the whole debt ceiling thing, since it was used by both parties in ways that created uncertainty and instability for financial markets. The debt ceiling, the legal limit of the total amount of debt that the federal government can actually borrow, it was introduced in 1917. The government technically hit the debt ceiling at the beginning of 2023 for the 79th time since 1960, which ultimately resulted in it using extraordinary measures to pay its bills and coming incredibly close to defaulting on its debts. Lawmakers reached a bipartisan deal on raising the debt ceiling just days before a June deadline, which, if it was missed, would have dealt a $12 trillion blow to the U.S. economy. I don't have to tell you guys that we didn't need that. Now, Jamie Dimon, he's not the only economic expert that's saying these things. Former Treasury Secretary Larry Summers, he called the downgrade bizarre and inept in a post on X/Twitter, and he even said that the economy currently looks even stronger than expected. Economic data released last week showed that the United States economy grew faster than expected in the second quarter of the year. Meanwhile, U.S. inflation cooled for the 12th consecutive month in June, slowing down to 3%. But really, are you guys feeling this yourselves? I mean, you feeling that inflation cooling off a little bit? Meanwhile, sitting Treasury Secretary Janet Yellen, she lashed out at Fitch and insisted that the United States remains the world's largest, most dynamic, and most innovative economy with the strongest financial system in the world. What do you guys think? Do you agree, or is she just smoking on something? Now, the decision from Fitch marked the second credit downgrade in U.S. history, and it's sounding a major alarm with implications for the economy and everyday people's finances if the United States debt continues to grow. I mean, let's face it, guys, this rating downgrade, it's not exactly happening in a vacuum. It comes months after a federal stalemate delayed a debt ceiling agreement until days before the U.S. was expected to lose its ability to pay outstanding financial obligations. Analysts downplayed the immediate economic effect of the rating decision, but said that it's definitely sending all sorts of signals about the path that we're on. A path of increasing debt that could ultimately raise the nation's borrowing costs. It could threaten economic growth, and it could hike interest rates for consumer loans like credit cards and mortgages. Credit rating decisions, just like the recent one by Fitch, they all boil down to a fundamental concept. Can a nation handle its mounting debt? And guess what, guys? America has been racking up quite the bill. See, the federal government's annual spending has pretty much been out of control lately, and it's nowhere near the tax revenue that it's been pulling in. As a result, the U.S. has piled up trillions upon trillions of dollars in debt. Now, this isn't just a one-time deal, guys. The U.S. needs to keep making these payments, or it could risk defaulting on the loans. So this downgrade, it's like leading to something bigger. If investors start feeling uncertain about US's debt paying capabilities, then, they're going to want some extra reassurance. And how do they get that? By demanding higher interest rates for loans, meaning higher interest payments for the U.S. and its taxpayers. That's me and you. Now let's go ahead and connect the dots here. Higher debt costs, they can throw a wrench in government plans to spend. Social welfare programs like SNAP, EBT, Social Security, projects that give the economy a boost, well, those could face funding cuts. And so that means stuff like Social Security and Medicare. Now, in the long run, this could definitely slam the brakes on economic growth, and it could leave the country exposed to all sorts of financial crises. And don't even get me started on how this debt and interest payment circus impacts us taxpayers. You see, guys, the bigger the debt, the more dollars that are going into interest payments. Money that could have easily been used to actually, grow the economy or help out everyday Americans. It's like money going down the drain, not creating any value for the working class. It's not creating any wealth, and it's not creating jobs. Then there's the future crises to worry about. Less flexibility, less resilience. Global investors see the United States Treasury bonds as the highest form of safe investments. But guess what? If this ever changes, we should very well be worried. For everyday people, the possible financial impact would be pretty similar. Long term rather than immediate. If the United States debt grows and the government struggles to address it, consumers could face higher interest rates for loans since the nation and its borrowers would be deemed less trustworthy. And so that could mean higher costs for borrowing for everything from credit cards to mortgages to cars. But more immediately, the stock market ticked downward when the news broke. The tech-heavy NASDAQ fell nearly 2%. Meanwhile, the S&P 500 dropped nearly 1%. Experts are warning that if the government doesn't do something about these spending policies, then rates will rise. But others are not minding the whole thing and even calling it a great opportunity for buying stocks. Let me go ahead and break it down for you guys. So the US government is pretty skilled at a couple of things, overspending being one of them. You know the primary source of Uncle Sam's income? Well, it's income tax, over 90% of it. But here's the kicker, guys. The government's spending more than it brings in. To cover the gap, they're borrowing even more cash. Hold on to your hats, folks, because here's where it gets really hairy. The US government already $32 trillion in the red, and it's only getting worse. We're talking about adding another $1 to $2 trillion in debt each year. It's kind of like racking up student loan debt, but with no plans of ever paying it off. I mean, you can just imagine those interest payments on the massive debt, right? It's expected to hit a staggering $640 billion in interest this year alone. That's no small change. And if we keep up this pattern, we're looking at $1 trillion in interest payments within just 5 years. Yeah, you heard that right, guys. $1 trillion in interest. That's literally like throwing $1 trillion in the trash. Now, here's the multi-million-dollar question, or trillion-dollar question. I don't know. What's the US government's play here? Well, they got a couple of options, but neither of them is necessarily a walk in the park. Printing more money might sound tempting, but that could lead to a weakened dollar, more inflation, and a whole lot of chaos. We already tried that. Didn't work out too well. Now, on the flip side, massive spending cuts would mean slashing budgets for defense, Social Security, and a whole bunch of other vital programs. It's like picking between a rock and a hard place. But hey, I'm just here to give it to you guys straight. No sugarcoating, none of that. The US government's sailing into some pretty choppy waters. Now, with overspending, mounting debt, and an economy that's seen better days, it's a bit like trying to bail out a leaky boat with a thimble. Definitely something to keep watching for the next time. By the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below this video. Now, what if, and just hear me out, guys. Like, what if we let them feel the pain that they inflict on the citizens of this country? Just cut all politician benefits. Let them pay for their own security. Let them pay for their own healthcare meals, etc. Cut their pay. No retirements for any politician. They're well paid by their benefactors anyway. They'll be fine. Yeah, right. Just a wild idea, though. Now, I got some friends who tell me if 75% of the federal government disappeared overnight, the average US citizen wouldn't notice and their lives would immediately improve. Then I heard from some people maybe the government needs to just allow a bunch of homemakers to do the books. People doing the books at home, they'll have this country on budget and out of debt in no time. By the way, if you guys made it this far in the video, do your boy a favor, drop a quick like for the video. Also subscribe to the channel, and I'm gonna see you guys on the next one.